So we get some of that data, and then what we do here is we don't get it in the way that we need it, right? The FDIC just has a regulatory probability of funding of 20% for all unused commitments that have less than 1 year original maturity, and they use 50% in Schedule RCR for ones that have original maturity over 1 year. We want to get an average of those because we don't have over versus under 1 year as buckets up there. So we look at your balances of under and over a year, and we do a weighted average of those to get kind of a blended estimated probability of funding for your unused commitments based upon what little regulatory guidance we've had. So that's where that, in this case, 42% for this bank comes into play. Certainly, if you have some data that you can look at to see how likely historically your unfunded commitments have gotten funded, then that would be the best way to go for sure. But with lack of any good historical internal data, this we thought was a good starting point, very much like we've done with the prepayments. Then you have to estimate how likely the remaining commitment, the average remaining length of the commitments. And then the last piece of the puzzle is, so if these loans were to be funded with whatever balance is funded, what kind of losses might we see in the future? Now, of course, we've just done a great study on what kind of losses your actual funded loans have seen in the CECL analysis that we did here. So we take those values and we translate them here to give you a good starting point. But these, you notice everything in here on this page is overridable because some of this data might not be accurate for your institution, depending on how frequently you plug these things in on the call reports, and you might have much better data to go on. But we thought this was a good kind of module and methodology to get you to a number for a current allowance on off-balance sheet credit, or I guess an ACL for off-balance sheet unfunded commitments, and then that'll go into the balance sheet in the call reports next year as it does already this year. And we see what you have now, and we compare them, and we give you a surplus or shortfall for the unfunded commitment section that feeds into the summary on the first tab. I hope that was a comprehensive answer there. Yeah. Anything to add, Josh, on the unfunded commitments question?
Yeah, I think you're dead on. No areas to add to that. I think the main key is just reviewing to make sure that you do meet that unconditionally cancelable criteria if you are excluding it. And I think that's going to be a bit of an exercise because for some financial institutions, they may either do all or none in that. So it may be very easy, but I think that'll be an exercise to go through.
So yeah, we had a follow-up question that just about, does an on-demand feature in the note make it fall under conditionally cancelable? And I would say yes. Would you concur?
I would say a hesitant yes, but I would lean on legal counsel to determine that contract language. Is that a good CPA answer? Or
yeah, that was a perfect CPA answer.
And HELOCs are the biggest question mark here because I've read a lot of competing information, and I've actually heard that there are two different definitions of unconditionally cancelable when it comes to HELOCs: a regulatory definition and an accounting definition, and they are not the same. Do you have any light to shed on that, Josh? I've been meaning to ask that to somebody for a while, and I have never gotten a clear response.
No, I mean, it's definitely something we can look into, Steve, and try to get a better response for you. So I'm sure we'll get more into it as the year end gets closer. I think right now, for the most part, many banks are just trying to get the basics of it, and they probably haven't even tackled the unconditionally committed or cancelable items. And so, I think at the end of the day, the FASB, their information or documentation is unilaterally and irrevocably terminology or language. And so it may very well fall into probably just needing to look at those contracts, and it could involve maybe getting some legal advice.
My feeling based on the sum total of everything I've read is that the accounting definition is more strict, and then the accounting definition is what drives CECL. And so when in doubt for your HELOCs, unless you're sure they meet that unconditionally cancelable, I would lean towards not making them unconditionally cancelable unless you've really looked at the contracts. That's just my, and of course that's a more conservative suggestion as well. So all that, yeah, are my thoughts on it. Jumping to the other question about scale is it's a good question. So Fed release scale.
I don't know if it was necessarily about scale, Steve. I mean, it was really more probably about the ACL, those allowance rates.
Well, yeah, but that's, I mean, in the context of scale. So when, you know, the way the scale tool, the Fed's scale tool works is a little bit, I don't mean this in a mean way, I guess, but it's very backwards. And backwards meaning that you start by assuming that you are going to perform exactly like much larger banks, like I hesitate to call them peers, but that you're going to perform exactly like much larger banks. And then it's on you to let the model know exactly how you're not going to perform exactly like larger banks. And that's your scale CECL calculation, because it starts by looking at peer disaggregated reserve values. Remember the schedule RIC, which is that thing that starting about 2.5 years ago, the larger banks over $1 billion had to start filling out their loan loss reserves in buckets, in those 6 different disaggregated reserve buckets. And that's sort of that's the genesis of the scale tool, saying that, hey, we're going to assume that your reserve under CECL has to be exactly like these larger banks is on average, except for all the ways you tell us it's not going to. And then so you have all your adjustments to this, but the baseline is that. And that's a huge assumption that can be very difficult to defend, because most $100 million community banks are not going to say, well, yeah, I think I'm going to perform exactly like a $50 billion bank is going to perform from a reserve standpoint on my, you know, C&I loans, right? But then the way you modify that is to say, well, you know, you're responsible for saying exactly how you're going to perform different, but you don't know what the assumptions another bank used in their CECL, in their reserve calculation was, right? So it presumes that you know all the internal assumptions they made so that you would know how yours would be different, which is very challenging. It's one of the limitations of the scale tool. You know, in addition to the very little amount of segmentation available for running scale, it makes the Q factors extremely challenging from our point of view, which is why, you know, we think our tool is a much better approach to it. But certainly since the Fed came up with scale, we wanted to at least recreate it faithfully in here for you guys to use as maybe a secondary backup. But the question is a very good one. How, you know, you don't expect to be like your larger over $1 billion bank. So how do you use scale? Well, you have to estimate exactly how you think you might be different than them.
Yeah.
Which can be a big gap.
I think you can look at those as just an additional data point. I mean, really, that's part of the reason why we have the peer group and the net charge-off activity for the pools in the CECLSolver, to give you, as a smaller bank, a better representation of what's happening with banks, you know, similar to you, whether it's your UBPR peer group, whether it's a state peer group, or whether it's a custom peer group that you've created, right? We think those are the kinds of tools that are probably relevant. And these ACL numbers from the larger banks that are already filing, or to me, are just an additional, supplemental piece of information for you to consider. But again, I think the peer data we have in the CECLSolver and the ability to analyze those on an apples to apples basis is probably a much better, set of data points for you.
Yeah, and scale is it is a tool. The Fed put it out as a tool, right? Is it the right tool for the institution? That's something that every financial institution has to ask on any product that they're looking at any model that they're looking at. I think the biggest hurdle on the scale, as Steve was saying, is you got $1 billion to $10 billion loss information in this data that's being used in the scale model. How do you get that to your institution? And really, I think the scale tool it may be good for like a de novo that have absolutely nowhere to start there. So maybe that's a good start for them. But at the end of the day, you're always going to be 1 quarter behind on your data, which as you know, right now, we're week to week on our economic data. For the most part, just economic uncertainty. So 1 whole quarter behind. And then also right now you only have $1 billion to $10 billion data that are publicly traded banks that are there. And so the 1 billion to 10 billion non-public banks, those are going to hit on the 331 call reports. And then you're going to have a massive explosion of this data. And so really where I see the scale tool following into the game plan for financial institutions is dead on what Sean is saying, is that you would probably have a model that you're using. And if you wanted to look at scale, you may use the scale tool to see really how do you compare with the other financial institutions. You make it at that point after 331 when you got a lot more data. I mean, you may be in a state that there may not be a bank on that whole listing right now to compare to. And so if you're a bank in Alabama, you may be comparing yourselves, the closest quote unquote peer may be in Montana or wherever it may be. And so I think it's a good tool maybe to compare, but just know there are some issues with scale.
Thank you, Josh. Thanks, Steve. Steve, we had a follow-up question on the unfunded commitments, just where the 1 year average that we have kind of defaulted in our estimator comes from.
That's that's a plug. Since we don't have information on the remaining length of their unfunded commitments, just like we don't for the funded loans. And so that's something where they need to look and see what the average length of those remaining commitments are.
Yeah. And I would
Steve,
see banks handle this a couple of ways. We tried to provide our template as a place to kind of get you thinking about them. You know, we certainly see banks just anecdotally, you know, just applying the same reserve rate to the unfunded commitments as they are to their larger portfolios, or just, you know, subjectively assessing it, you know, given those commitments. Because it's important to remember, right, the idea is these are loans that do not exist yet. They certainly have the potential to, and that's why we have the probability of funding. But as of today, they certainly don't exist. But the standard wants you to consider, if those were to fund, you know, do you think a reserve is necessary for those? Okay, a couple of other questions have come in. Follow up kind of on the scales. You know, what do we think about the new method that the Fed put out on LE? I'll give my 2 cents, and then I'll let Steve and Josh add. You know, again, I think it's probably a response to the fact that, as we just kind of alluded to, scale didn't completely hit the mark. I think it's a follow-up attempt to try to again make you know, the analysis you know, to give the banks the ability to do it themselves. I really think conceptually, right, if you're at this point, there's still going to be a lot of work to do with the LE tool. So, you know, if you don't have your arms around the data, I mean, I don't think there's a problem with the tool, but it is going to require some work. And I think it's really a question at this point, you know, if you have the means and resources in your bank to make that an exceptional tool, right? I think the important reminder here is there's not one right way to go after CECL, right? This is a process. There's multiple methodologies. You can do portfolio, you can do loan level, you could use the LE tool. All of them, if they match up with your institution, are going to be perfectly appropriate. It's really at this point questioning, all right, where are we? What access do, you know, what are we constrained by data? And can we get a tool that's going to, you know, adequately assess what this reserve needs to be going forward? So, you know, the final tool that you select is really kind of a, you know, at the end of answering a lot of internal questions around your own institution and where you are with data, et cetera. So that's my long-winded way to pass it off to Josh and Steve. Anything you guys want to add there?
Yeah, I agree with that. And actually, I want to correct myself, because I mentioned when I was talking about scale earlier about it being an issue. There really aren't issues. They're just concerns, I think, from an accounting standpoint. Yeah. And I think that's with any simplistic model that you go to that's overly simplistic. And I think that's a balance that financial institutions are trying to kind of find that balance. When CECL first came out, we looked at having to do like 494 different models over every single pool. And it was a very complex, very scary scenario. I think over time, and as Sean has alluded to, it's evolved as time has gone by, which is probably one of the reasons that FASB said we want to give private institutions a little bit more time to kind of learn from the publicly traded banks. And so I'm definitely hearing more financial institutions that maybe have gone to a little bit more complex model than what they, in the long run, determined they needed. And so we're seeing some that may be trickling down to some more simplistic models, maybe looking at more pooling by call codes and so forth. And I think there's still, like, I still get calls from financial institutions that are already selected something, and they're saying, I still, even this late in the game, we may look at going something a little bit more simplistic. What I would say is kind of using the FAR scenarios. If you went with a very complex model, most likely that vendor is going to have a lot of documentation, assist you along the way. You probably got staff and resources internally that, I mean, some financial institutions have economists on staff that are helping them in this process. And so that's not the majority of the banks that we serve at Warren Averett. And so many are having to rely on either their own personnel, the CFO, chief lending officers, to get in, roll up their sleeves and adopt this standard. And so if you go to something very simplistic, say like Scale, where it's very like overarching, you're using peer data that really isn't peer data, you're going to have to really hone in and spend probably more time documenting how you're getting that data to be your own data for your financial institution. And so what we are seeing are more banks are kind of going in the center. So something that's complex enough for their institution, but not overly complex where it's just too hard to maintain, something that the audit committee can understand, the regulators can understand as well. And so again, it's really finding that time, and everybody, not just public accounting, but financial institutions, they're struggling right now to find great talent, and there's a balance from that standpoint. And so does it hurt to look at it? Absolutely not. I think Sean is right. Ellie is probably a better option than Scale. But then again, I think you just have to look at every single step of the way to make sure you're determining that it's the right fit, and just know that it may cause your internal resource and have to spend a little bit more time documenting. And along those lines, I'll just make one quick comment too, just on the pooling, that it's a good exercise and one that you'll have to do on the pooling, just to make sure that all those risk characteristics are identical. So for instance, if hotel loans, if you got 5 hotels that are plugged into one call code, you may have to extract that because it probably doesn't have the same risk characteristics as that call code. And so just make sure that you are taking a holistic approach if you're using call codes, but you will probably have to get down to the loan detail level at some point, just to ensure that the risk characteristics are the same.
And I think that's where the data, the availability of data comes into play, right? We have lots of institutions we work with that say, well, you know, how similar do the risk characteristics have to be in order to be able to justify keeping them in a pool? And I always feel like it's a bit of a double-edged sword. You can, if you could define, you could say no 2 loans have identical, perfectly 100% identical risk characteristics, right? There's something slightly different about every single individual credit. So how similar do they have to be? And my answer usually has to do with, well, how much data do you have? Do you, if you wanted to split off these 5 hotel loans because they're a somewhat slightly different risk characteristics than the call report code, but with the call report code, you have excellent data going back 15 years. That's perfect with charge-offs, recoveries, past due, external data, environmental peer data. And the hotel loans, you have sketchy data. It doesn't go back very far. There's nothing apples to apples comparable from an external peer data standpoint to help you make forward-looking assumptions about its performance. It's a trade-off there, and I think it's one that we're all going to be always, you know, fighting with and challenged by.
Yeah.
Great, Steve. Just a few more questions. Hopefully we can get to. I know we're approaching an hour, so we'll run over to take these. Just a quick comment that there was. Can we go over the security section from CECL?
I'll pull it up, Sean, if you just kind of want to briefly summarize.
Yeah,
you know,
so again,
your thoughts on it.
Yeah, CECL obviously requires, you know, some allocation be there for held to maturity securities. I would tell you, you know, we're for 95, if you know, closer to 100% of the banks. Most of you, while we've obviously seen securities portfolios have exposure to interest rates this year, most of you hold things that if you hold them to maturity, such as a CD, an agency, a treasury, a government-sponsored mortgage-backed, a bank-qualified muni, typically do not pose any credit risk to your institution. However, there are a small percentage of banks who may own sub-debt corporates or other things that actually do contain some interest, or excuse me, some credit risk. So it's really, again, kind of, looking at your portfolio, determining if there is anything. But if you do hold the majority of your securities to maturity, then you're really not going to have any credit exposure per se. But we want to allow you to be able to see that portfolio and document it if there is a portion of it that does, hold some credit risk.
Yeah,
Josh?
Sean, the only thing I would add to that is, we talk a lot on CECL with held to maturities, but just know that available for sale securities, for the most part, you're going to account for that the same as always. The only difference there is that there will be no write downs. Now there will be an allowance instead of writing those securities down if there is an impairment. So that's really the only change on the AFS.
Perfect. Thank you very much, Josh. Just a couple of other things here. Where do we put the warm in for custom loan pool types in the tool?
We don't. So the answer is for custom loan pools, we don't have the historical, right? The historical data doesn't exist in the public realm. So the challenge, using any tool, including ours, is if you're doing a completely custom loan pool, you're going to have to do that historical lifetime loss calculation yourselves. We can certainly walk you through how to do it. We have, if you look at the historical analysis tab, you can see how the calculation is done. But since we don't have the historical data, we can't help you with that historical loss calculation on a custom pool. The warm value is used only to calculate what that historical loss calculation is from a mathematical standpoint in the first half of the model. So we don't have a spot for it, because even if we allow you to plug it in, it wouldn't do anything mathematically in the tool, because when you plug that in, it then calculates the historical loss rate, which we can't do for the custom pool. So it's just that's not a part of the tool.
And I would add, that's part of the reason why I think this is going to be a little bit of a journey with CECL, right? Is that lack of available data exists for most banks. And I think that was a practical realization on the part of the regulators and frankly, the auditors too, right? That this is, going to potentially, again, be something that banks are going to need to capture in the future. It is why we say you should, at a minimum, be, essentially writing yourself an insurance policy. We define that insurance policy as the ILDR file or the loan tape or the alert file, but you should begin warehousing that type of data because that will contain the loan level information, so that in the future, if you do need to stratify and subset, you will have that historical available information for you in the future. Again, most banks simply don't have the ability to put their arms around that data now, and that's why portfolio solutions have become so popular. We do think going forward, even if you're using a portfolio solution, you should begin warehousing that type of data. That's the type of data we can assist you with in telecredit. But again, if there's no data there, as Steve said, there's nothing to really see. All right, so just a couple of additional questions. Since banks are already required to calculate loan prepayment speeds for their IR model, won't banks just use the same prepayment speeds in their CECL model? Won't they need to be consistent? I think there's certainly, validity to that. I mean, obviously, a lot of times, depending on everybody's a little bit different. Again, some banks may have that just on their entire portfolio as a whole, but it may not perfectly match up with the different buckets. So again, I think it's certainly a piece of information that you can certainly utilize. And if you want to be consistent, it makes perfect sense. Again, this is an area where you do start to dip into, precision over accuracy, right? You want to make sure you have a reasonable and supportable and defensible prepayment assumption, but obviously that's going to lower the your warm. So again, it's a little bit of a balancing act, and one that's probably determined best by each individual.
Yeah, so I think it's a two-part. I think exactly there's a simple answer and a complex answer. I think the simple answer is, yeah, it would make sense that those prepayment assumptions should be in line with each other. But then I think, well, are the buckets the same? Are we using the same, we're looking at call report, buckets for CECL. Are you doing that call report buckets in your interest rate risk? And then you're thinking about, well, what's the time horizon for your interest rate risk projections? Are you just projecting, estimated prepayments over the next year or year and a half? Whereas with CECL, you're making a longer time horizon. So you can get very granular, or you can start with a basic assumption that, yeah, if you have good interest rate risk calculations for prepayments, start with that and then modify as you have better information.
Josh, anything to add there?
Yeah, I think that's dead on. The only thing, you know, you would want to understand the interest rate risk model and how they're coming up with their prepayment speeds. And you may very well already know that. You know, if you use that data, that's already there. I think many banks will migrate there to look at how that data is being captured. Is your vendor using peer banks or some kind of internally calculated prepayment speed that they just automatically go to? You may have to look at that and say it may not be reasonable. And so you calculate your own, and it could lead to a reversal where we're thinking, well, wouldn't we just pull the interest rate risk model data and use that, where during this exercise, you may realize that you need to use your own information. And then now you may be sending your actual information to be used in your interest rate risk model. So I would look at it both ways.
Great. I think this will be the last question we take. What happens with loans eliminated as impaired for calculation of FAS 5? If the ECL is being produced for those loans based on the approach we choose that generates a specific reserve, is this sufficient? If we agree to that calculation, of course, we'd still be keeping on. So I'm not going to read the rest of the question. Josh, what are your, how would you talk about the, specifically reserved or impaired calcs, as it relates to CECL?
Yeah, I mean, I think ideally we would want to make sure that we follow the risk characteristics, that we continue to pull every loan that we can within similar risk characteristics, and it falls within the model. There may very well be times where we look at impaired losses. There's actually a practical expedient that allows for collaterally dependent loans to be reviewed, and you would document your impairment based on kind of how we do it now. We would say if you got $1 million loan and the fair market value is $500,000, you subtract out whatever your cost to sell is, and that ends up being your impairment. And that there is a practical expedient there. I think along with all of the other pooling, we just want to make sure we're not doubling up on what we're calculating in the ACL.
And that's what our tool allows when you plug in any individually assessed loans or pools of loans. Then they get stripped out of the parent bucket, so that we're not, assuming a lifetime future loss rate on the collective balance, and then assuming that same loss rate and then additional loss rate on the individually assessed. The individually assessed are done, the total loss on those, and then it's separate from the loss on the collected pools, which is the way we set up the tool.
Awesome. Thank you, Steve. Thank you, Josh. This has been fabulous. I'm sorry we ran over a little bit of an hour, but thank you so much for the questions. Again, hopefully the recording worked. I think when we switched screens, it paused for a second, so we may have a little bit of a break, but I think I got it caught back up. But we will send a copy of the slides to you. So thank you all very much for attending. Thank you to Josh for joining us today. Thanks to Steve. And, we'll be back again next month. So let me just put up the slide here at the end.
Oh, yeah.
You. Oh, shoot. Let me see here. Reshare my screen. There it is. Bear with me 1 second. Yes, so September 16th, we'll be back for the next session of Coffee Talks. We do have a webinar for any new participants at the end of August, but we will look forward to, certainly in the interim, if you want to have a demo with your data, just reach out to us at info@quickrate.com or just call us and we'll schedule a Zoom and we'll take you through the tools. So again, thanks to Josh. Thanks, Steve. Thanks to all of you for joining in, and we hope you have a great weekend. We'll talk to you soon. Thanks.
Thanks, everybody.
Thanks, everyone.